Welcome, this is Don Kaufman over at TheoTrade, and in this video what we're going to discuss is the options to trade. So I get this question pretty consistently, and that is simply like, well, what options do I trade? Because to put this quite eloquently, there's a lot of options on them. They're options, and that is if you take a look here. We're looking on thinkorswim. I have brought up Netflix inside of the trade tab, and you can see, well, of course, there's 3-day options, there's 10-day options, there's 16-day options, and 23-day options, and oh my! So it's just a tremendous amount of choices, if you will, on them there options. So when we ask the question, the options to trade, like what options to trade, really, it depends on what you want to try to accomplish. So first and foremost, if you're looking to do kind of an intraday trade, okay, an intraday trade, you're in and out the same day. Simply put, use the shortest duration options available, okay, and try to get a fairly high delta. And I'll explain this a little bit more detail here momentarily, but all I've done is I've actually changed one of my information layouts here on thinkorswim to delta. Delta, the rate of change of the option for every dollar increment move in the stock. So what like a 90 delta kind of means is that the option is moving at what? A rate of about 90 cents for every dollar move in Netflix, up or down, or whatever underlying that happens to be. So using a deep in the money option, and that's what this really is, using a deep in the money option, a deep in the money call. If you were to buy a deep in the money call, that is a stock substitute. It's a long stock substitute. If you wanted to get short something like Netflix here, you could use a deep in the money put. Buying a deep in the money put, 85, 90 delta is a short stock substitute. So again, this idea of quote unquote which options to trade, well, ultimately we could spend, days, hours, weeks in no particular organization there looking specifically at which options to trade. I mean, that really is, one of the ultimate questions over here. And you do have to develop kind of your own criteria. So in this, I guess, introduction to which options to trade, again, for like a stock substitute, you want to use these in the money options. Again, buying in the money call for a long stock substitute, buying in the money put for a short stock substitute. However, the question may arise, why do I use an in-the-money option? Because these at-the-money options, or even out-of-the-money options, they can actually suffer time decay. They can suffer like risk in terms of volatility. That is, if volatility, okay, on an option that you buy, if volatility goes down, these at-the-money or out-of-the-money options can suffer some fairly large volatility risks. Whereas the in-the-money options, they're trading predominantly with what's termed intrinsic or real value. And you can even pull this up on thinkorswim too. You can look at what the intrinsic value is, and you can see in this case, here's an option that I've kind of highlighted, and I'll do it even a little bit more justice here. But the intrinsic value happens to be $8 and roughly, 67 cents. Then the option is trading for, let's say like a mid price here of about $8.90. That's fair, $8.90. So you're paying the vast amount for this option. You're paying of real value. That real value, okay, it doesn't go away unless the stock, of course, were to go down substantially. Then anything additional you're paying, which in this case is really only like, 20 cents additional. So, and again, we can take a look specifically at this without necessarily having to calculate it in our head. You can look at what's called extrinsic value, which is the time value component. So, well, options bouncing around in price right now, but you can see the extrinsic component is about 31 cents. That really limits time exposure, it limits volatility exposure. And the same is true, like if you look at the at-the-money options, they have $2.45 of extrinsic, which means The extrinsic value, that's how much time risk you have, and that's how much volatility risk you ultimately have. So again, the reason for the stock substitute is, okay, several fold. Number one, stock substitute means you don't have to go out and buy or sell a $126 stock. And number two, in the right options to trade, you better know which options have volatility risk, which options have time exposure risk. But for intraday trade, pretty comfortable using anywhere above about an 85 delta, as a stock substitute. Thanks a lot, everybody, for joining us over here at TheoTrade.